This is Scott Becker with the Becker Business Minute, the Becker Private Equity Podcast. The story today is on fragility and debt. As I see more and more companies file for bankruptcy and more businesses look at bankruptcy in 2023. Obviously, the amount of interest on debt kills. But more important than the interest rates going up, literally gone from 5 to 10% for a lot of private equity sponsored companies, you've got the situation where debt leaves you in a spot where you're unable to take chances. It makes you fragile and it makes you less flexible. If you've got too much debt, you don't have the ability to change directions, to make pivots, to do other things. You're sort of stuck in a box. And that's the story that we see in a lot of American commerce today. As I see Party City go bankrupt, as I see Bed Bath & Beyond go bankrupt, Bed Bath, it's very clear to see where they lost their vibe. But I think if they didn't have so much debt and so many stores and so many locations and less fragile, a lot easier to try and find ways to solve the problems and make pivots. When you have too much debt, you can't do that. You're fragile. So debt, as an individual, a company, a country, we're huge proponents of get your debt down. Don't over-leverage yourself. Thank you for listening to the Becker Business Minute Podcast, the Becker Private Equity Podcast.